What if I told you there's a loan program out there that's designed to help you buy a home with zero down payment, even if your credit score isn't perfect? That's right, we're about to uncover the USDA loan program. This is really a hidden gem for rural home buyers. But there is one crucial mistake that could disqualify you instantly. In this video, we'll break down the USDA loan process step by step, the 2025 loan requirements you must know, and we'll even compare USDA versus FHA to help you decide which loan is best for you. Now, I always like to take these videos from the top, so let's start with the basics. What is a USDA loan, and why is it one of the most affordable options for home buyers in rural areas? So what is a USDA loan? It's a mortgage loan offered to rural property owners by the United States Department of Agriculture, the USDA. Now, with that said, there are actually two different types of USDA loan programs. One is the direct loan program, which is essentially designed for low-income households. And also something to note, this loan is a little bit more restrictive, but one of the key things is that the payments can actually be subsidized. But with that said, USDA Direct actually have to be done directly through the USDA and not really the one that we're going to talk about today. But the second one, and probably the most popular, is the USDA Guaranteed Loan Program, which is catered to more moderate income households and actually backed by lenders. So you can actually come to a team like ours and get a USDA loan without having to go to USDA directly. Now, enough about the two loan programs. You're here for the requirements, you're here for the benefits, and this is really where you need to pay attention because this is really what encompasses USDA. No down payment. That's right, they require zero down payment when you're buying a home using USDA. But with that said, there are some additional requirements that we need to talk about. One is credit scores. Now, one thing about USDA is they don't really have a minimum credit score. I've been told you can go as low as a 580, whereas everything online really says that USDA wants to see somewhere around a 640 credit score. Now, if you have a 640 or above, you can use their automated underwriting engine, or better yet, our team can, in order to help you get approved. Now, if you have credit scores below 640, it requires something called a manual underwrite, which means we don't really get automated approval when trying to get your loan approved. It requires additional steps, and typically with those additional steps means that you need additional reserves, you need compensating factors in order to qualify for that loan. So if you're somebody that's on the fence considering USDA versus some other loan programs out there, understand there's a really good chance that you're going to need at least a 640 in order to use USDA, because a lot of lenders out there have something called overlays on their program. So even though USDA says we'll go lower than a 640 and it requires this manual underwrite, what happens is that lenders out there who are doing USDA loans by these guidelines are saying, you know what? Because they really want to see a 640, we're not going to do any loans under 640. So we're going to put this overlay that says if you don't have at least a 640, then you're not going to qualify for a USDA loan. When in some cases, you might actually be able to qualify. So just understand there's a difference in what USDA allows versus what some lenders out there require when it comes to things like credit scores and debt to income requirements, which we're going to talk about here more in just a minute. On top of USDA loans not requiring a down payment and allowing lower credit scores, they also have competitive interest rates out there when you compare them to conventional loans. As of the time I'm filming this video, 30-year fixed rates are somewhere around 7.25%, whereas USDA loan rates are sitting somewhere in the mid 6.5% range, 6.5 to 6.7. So it's about 0.5% better than conventional loans. Now that you know the basics, let's dive into some of the eligibility criteria. And if I'm being honest, this is where most people are going to stumble in the process. And the biggest hiccup for most people when trying to qualify for a USDA loan is the income limits that are based on household size and location. Because USDA loans are meant for low to moderate incomes, your household cannot exceed a certain limit, which varies depending on the region and the size of your household. In layman terms, that means that your income, your total income for everyone in your house over 18 years old cannot exceed 115% of the area median income, which means if I was looking to purchase a house where I grew up, back in Lenoir County, North Carolina, I grew up in Kinston, a small rural town out in the middle of the country that probably does a lot of USDA loans, you can't make more under the moderate income requirements than $112,450. And in the case of that area, that's all the way up to 4 people. So if you have 4 people living in a home and each of you makes $50,000, for example, say there's a husband and a wife, and you have two 18-year-old kids that still live in the house, and everyone is making $50,000, and that's a $200,000 combined salary. That means you make more than USDA actually requires. But let's say, for example, there's only a husband and wife living in the home, and the husband makes $50,000, and the wife also makes $50,000. There's no additional income coming from anyone else in the home, then essentially you're going to qualify under those income limits. But something to understand, depending on where you're looking to buy, that number is going to change. So you can have two counties directly beside each other. One might allow you to make more income than another county. But with that said, I'm going to drop a link in the description of this video where you can actually go put in a property address, and not only will it tell you if it qualifies for a USDA loan, it'll also tell you the income requirements so that you can have an idea before you ever speak with a mortgage professional of whether or not USDA is a viable option for you. Now, I just hinted at something else, and that's that the property has to be located in one of these designated areas per USDA. Not all homes meet the eligibility requirements for USDA. In fact, most of the suburban markets that are high density, that have a lot of people, I'm located here in Southern California at the moment, most of Southern California where I'm located near the coast isn't going to qualify for a USDA loan. You have to go further out into rural areas in most cases in order to use USDA. But as an entire country, when you look at the United States, more homes are going to qualify under USDA because there's a lot more rural land than there are these small pockets of high density. But just understand, if you're someone looking for a home in a really popular area, Seattle, Tampa, Raleigh, any of these major cities out there, chances are you're not going to be able to do a USDA loan. But if you're able to go on the outskirts of some of those cities where it's a little bit more country, a little bit more rural, then chances are there's probably an option for USDA. Now, like I mentioned earlier, there's going to be a link in the description of this video where you can put in a property address to see if it actually meets the USDA eligibility requirements. But there is something else to note when it comes to looking at property, and that's that the property must be your primary home. It cannot be an investment property. It has to be a property that you're going to live in. Now, you can turn it into a rental after you've lived into the property for at least 1 year, but when you're buying it, putting zero money down, and you're doing USDA, it has to be your primary home. In addition to that, you do not have to be a first-time home buyer in order to use USDA. So here's the thing, you can use USDA even if you've owned a home in the past, but what you can't have is a bank account with a large amount of money in it that you could potentially use for a down payment and use a USDA loan. USDA loans are really for those low to moderate income families that don't have the money for a down payment. So just keep that in mind when you're going through the process. In fact, when you're watching this video and you're saying, yeah, I meet that requirement, I don't meet this requirement, what am I going to do here? And we're going to talk about how to calculate debt to income ratio here in just a minute, which is an important piece of the process because that's how a lender is going to tell you how much home you can actually afford. Don't just go off this video. Make sure you're working with a professional, going through that process, and having them dot the I's and cross the T's to make sure that you actually qualify for a USDA loan program. Now, if you're watching this video, you're not sure where to start, my team and I help a lot of people here on YouTube, not only with USDA, but all loan programs out there. So if you think you're ready to start, or if you have questions about the process, reach out to our team directly using that link in the description of the video. Now, the other thing to note about a USDA loan and buying property is that the property can't have any income producing pieces of the property, if that makes sense. So you can't have a property that's on a working farm if that farm is actually making money. USDA doesn't allow it. Now, you can set up a small business in your property, that's completely fine. USDA is there to finance residential property. It's not there to finance farmland. It's not there for you to buy land and build a home. It is rather there for you to buy real estate as your primary home and not try to run some business off the land. Now, one other thing I want to note when it comes to eligibility requirements is there is no maximum loan amount when it comes to USDA. Now, they do have debt to income requirements, which is essentially going to restrict how much you can borrow. So you're not going to be able to just borrow unlimited amounts because there's no max loan amount, but rather you can only borrow based on your ability to repay, which is essentially your debt to income ratio. Now, before we dive further into USDA, I want to take a minute here and compare USDA to FHA, because a lot of people considering USDA might also consider FHA because of the eligibility requirements with, having to make a certain amount of income or the property not being in a certain area. And in fact, FHA is the best option because there is no maximum income that you can make, and the property can essentially be in any area when it comes to FHA. So if USDA doesn't work for you, make sure you're also looking at FHA. But the biggest differences in the two is that USDA doesn't have a down payment requirement, whereas FHA requires 3.5% down. USDA has limits on how much income you can make and has stricter location requirements, whereas FHA really has neither. But there is a big difference when it comes to upfront costs when you compare USDA to FHA. And it really comes down to the down payment. FHA, you need at least 3.5% down, whereas USDA, you have no down payment requirement. And on top of that, FHA has something called upfront mortgage insurance, which is 1.75% of the loan amount, compared to USDA's guarantee fee of only 1%. So when you're really comparing apples to apples, you're saving about 4.25% using USDA versus FHA. But one thing about FHA, they allow you to finance more home with more debt. So it's really a more lenient loan program, especially if USDA isn't an option. Now, before we dive into the mortgage insurance requirements and how to calculate it, do me a favor and give me a thumbs up if you found any value in this video at all. And if you like content like this and want to stay updated on everything real estate and mortgage related, do me a favor and subscribe to the channel. I want to take a minute here and talk about mortgage insurance. Scary mortgage insurance. Mortgage insurance is required when you do a loan and you put less than 20% down. So if you were getting a conventional loan and you were only putting 10% down on that mortgage, you would have to have mortgage insurance. Well, programs like USDA, programs like FHA also have mortgage insurance because you're putting less money down. And in the case of USDA, not only do you have monthly mortgage insurance, you have an upfront guarantee fee. Now, they call it a guarantee fee, but essentially what it is it's mortgage insurance. It's just built into the loan amount. It's there to protect the lender, to offset risk in the loan. Because you're putting less money down, they need something there to protect themselves in case you end up defaulting. Because you're putting less money down, because they allow lower credit scores, you're essentially a higher risk to that lender, which means you have a higher likelihood of defaulting on your loan than somebody that has, say, an 800 credit score. Because of that, they have that upfront fee, which we're going to show you how to calculate, and they also have monthly mortgage insurance. Now, with your typical conventional loan, after you pay the balance down below 80%, so you have at least 20% equity in that property, the mortgage insurance is going to go away. On USDA, it's there for the life of the loan. So for as long as you have a USDA loan, you're going to have that mortgage insurance on it. Now, it does go down as you continue to pay your balance down, so it's going to get less and less the more money you pay on it. But in all reality, once you get at least 20% equity in that property, it's probably worth considering refinancing, getting out, and maybe removing that mortgage insurance entirely, depending on where you are. And as we mentioned FHA earlier, FHA also has monthly mortgage insurance as well as that upfront mortgage insurance, which we said earlier. But when it comes to USDA, it's 1% of the loan amount for that upfront fee that they require. And so essentially, if you're buying a $200,000 home, instead of financing $200,000 because you're putting no money down, zero down payment, you're essentially going to be financing $202,000. And that's because they add 1% on to that loan balance. In order to figure this number out, it's basically just take your loan amount times 1.01. So if you're buying a $300,000 home, you're essentially financing $303,000. A $500,000 home, $505,000. So it's just getting added to that balance. Now, on top of that, you have the monthly mortgage insurance, which is going to affect your bottom line more so than anything else because it's going to be part of your principal and interest, your property taxes that you're paying, your insurance that you're paying. You're also going to have that monthly mortgage insurance. Now, one nice thing about USDA is that it's only 0.35%. So it's considerably cheaper than FHA. And in most cases, it's going to be a lot cheaper than conventional loans. So while you do have to have it, just understand it's the cost of doing business. Without that fee, you're essentially not going to get the loan. So I know a lot of people gripe about it. I don't want mortgage insurance. Well, if you don't want mortgage insurance, you got to put more money down. So if you want to do this program, put zero money down and get the benefits of using USDA, unfortunately, you're going to have monthly mortgage insurance, regardless of your credit score, regardless of anything else. Every single buyer using this loan program is going to have it. So in order to calculate it, what we do is we take your purchase price. So a minute ago, we used $200,000. We're going to add that fee on top of it, like we said earlier, that guarantee fee, if you will, which is taking the 200,000, multiplying it by 1.01, which in this case gives us 202,000. That's our base loan amount, if you will. We're going to take that and we're going to multiply it times 0.0035. That's 0.35%. And in the case of our example here, that's $707. Well, in order to get the monthly fee, we take it and we divide it by 12, which in this case comes out to $58.92. Now you can do the same example for 300, 400, 500,000. It's using the same exact formula. So understand, the more you're financing, the higher your monthly mortgage insurance is going to be. Now the last thing I want to talk about is debt to income ratio when it comes to USDA. And I think it's really important to understand what debt to income ratio is before diving into the requirements that USDA has around it. So your debt to income ratio is your debt divided by your income. So let's start with the basics up front and talk about your income. Your income is going to be restricted per USDA, as we mentioned earlier. But in our video here, we're going to just say that you make $100,000 combined. Let's just use a combined salary for purposes of our video here. So let's say we have two people, they both make $50,000 each. So you got $100,000 combined salary. So we take that number and we divide it by 12 before any taxes come out. It's your gross monthly salary. Yes, we use your gross. The lenders are going to use your gross before any taxes come out. Yes, I understand that you have things that come out. You know, you pay taxes, you pay money into a 401k, you pay different things that come out of your check. Well, the lender's not going to do that. They're going to use your gross before it comes out in order to calculate your income. So in the case of $100,000, that's $8,333 per month. So that's the income piece of the debt to income ratio. Now, in order to figure out your debt to income, we need your housing expenses. So when it comes to debt to income, you have your front end ratio and you have your back end ratio. The front end ratio on debt to income is the housing expenses. That's everything associated with the property that you're buying. So the principal and interest, the taxes, the insurance, the mortgage insurance that we mentioned earlier, all of those added together gives us our front end ratio. Whereas our back end ratio is all of those housing expenses that we mentioned just a moment ago, same housing expenses, plus any debts that show up on your credit report. Things like car payment, credit cards, student loans, any sort of installment loans. You have a furniture loan that you got from someplace, that's probably on your credit report. That's going to be part of your debt to income ratio. Now, they only use the minimum monthly payment. So even if you pay more, they're not using the amount you pay, they're using the minimum monthly payment, and they're adding it to your housing expenses in order to figure out what your total debt to income ratio is. So in the case that you search online, what is the USDA's max debt to income ratio? It says online that it's around 41%, which means that you can't have more than about 41% of your housing expenses plus any debts that show up on your credit report going towards your overall debt when you divide it into your income. So let's say, for example, the home that you're buying has a total monthly payment with everything included of $2,500 a month. So we take that $2,500 and we divide it into the salary that we mentioned earlier, which is $8,333. In that case, that's 30%. So your front end ratio in this example is 30%. Let's say, for example, you have a $500 car payment, you have $250 in credit cards, you have $100 in student loans, and you have $150 going to just miscellaneous things. So in all, you have $1,000 a monthly debt that you pay every single month that reports on your credit report. So what we do is we take your $2,500 housing payment, the proposed housing payment, we add that $1,000 of monthly debt that shows up on your credit report. So now we have $3,500. We divide that into that same $8,333, which gives us a 42%. So in this example, your front end ratio is 30%, your back end ratio is 42%. Now, as I mentioned, if you search online, it says that the max back end ratio is 41%. Well, here's the thing. A lot of times they lean on the more cautious side. You can actually go above a 42%. I believe in talking to a lot of different lenders out there, you can go as high as somewhere around 45% on the back end. Now, USDA likes to have lower front end housing requirements somewhere around 34%, which means you can't have more than about 34% of your income going towards housing. And then you can't have more than about 10 or 11% on top of that going towards your overall debt. So overall, they really want your debt to income ratio under 45%. And in fact, in order to push those numbers, you're probably going to need higher credit scores. You're going to need some compensating factors, maybe some money in the bank, even if you're not using that money, in order to help you push these guidelines. Now, understand, lenders have guidelines that they go by. Now, sometimes they're a little bit more lenient on those guidelines if you have things above and beyond what they're looking for. So if you have higher credit scores, if you have some money in the bank, if maybe your income is a little bit on the higher side versus where your DTI is, these are all things that help you push some of the other pieces of the puzzle. Now, with that said, there are some things that they just can't get around, and that's why it's really, really important to make sure you're talking to a lender early in the process. If you're considering using a USDA loan and you're still 3, 6, 9 months out from doing it, it's not going to hurt you to start talking to someone now and working through the things that you need to work on so that you're in the best position possible when the time is right. Now, if you don't know where to start, my team and I would love to help. You can get in touch with us using the link in the description of the video. Now, one of the last things I want to cover in today's video are closing costs. Now, a lot of people believe because they're buying a home that doesn't require a down payment that there's not any fees involved. Unfortunately, you're probably going to have closing costs in most states out there, depending on where you're buying. In fact, you're going to have closing costs in all of those states, but in some cases, you might be able to get them covered. In the case of maybe getting a seller credit or different concessions in the process when you're submitting an offer in order to cover those costs. But just because you're getting a 0 down loan doesn't mean there's not going to be any cost involved. In fact, I recommend having somewhere between 2 and 3% towards closing costs, just in case you need it. Now, if the lender's willing to cover it because you're building it into the price, or maybe because the home's been sitting on the market a while, and one of the pieces of your offer is to ask them for a credit that you can use towards closing costs, great. And that's because USDA will allow you up to 6% towards concessions. So you can ask a lender for up to 6% to use towards closing costs. Now, most sellers probably aren't going to give you 6%, but just say, for example, you're buying a $300,000 home and your closing costs are $6,000. Well, you can go to the seller when you're making your offer and ask them for a $6,000 credit up front to cover those costs and essentially buy that home with no money. The other cool thing about USDA is that if the home appraises than the purchase price, then you can actually wrap the closing costs up into the loan. In the example that you're buying a $300,000 home, let's just say that that home appraises for $305,000, but you're buying it for $300,000. That means essentially you have 5% equity already when buying that home. Well, USDA allows you to use that additional $5,000 towards closing costs. So in the example of a moment ago where you had $6,000 of closing cost, if you were to wrap $5,000 up into that loan, you only have to come out of pocket with $1,000 in order to buy that home with no money out of pocket. And if you're able to get the seller to pay that $1,000, then essentially you are buying that home with no money down. But the expectation from a lot of people is that because there's no down payment, there should be no closing costs either. That's not true. You're going to have closing costs, but there are ways to cover it. So you're going to probably want to have some money set aside to use in case the seller's not willing to cover it. Now, if you don't have any money at all, then buying a home's probably not the right option. My recommendation is having the money. Whether or not you need to use it, that's a completely different story. But it's important to note that you probably are going to have some just in case all the closing costs are not covered. Now, with that, the last thing you're going to need is steady income and steady employment. So we've already talked about the income restrictions. You're going to need a job. You're going to need to be on that job consistently for the last 2 years or so. Now, most lenders want to see you working in the same line of work for 2 years. Doesn't mean you have to be at the same exact job for 2 years. You just need to be doing something similar in that line of work. So if you were in sales, you typically want to be in sales. What you don't want to be is going from sales to being a hostess at a restaurant or, big changes in job type. You kind of want to keep that consistent. Income needs to be consistent, but this is where most people get it wrong because you can have layoffs, you can have gaps of employment, but this is really where it's important to make sure you are talking to a lender up front before getting into the process, before getting under contract, just to make sure that your income, your employment is where it needs to be. Earlier in the video, I mentioned there's one crucial mistake that could disqualify you instantly, and it really comes down to income and employment. So you want to make sure income is good, employment is good before you ever get too far in the process. The easiest way to do that is make sure you're working with a professional. My team and I help a lot of people here on YouTube, and we would love to help you. You can get in touch with us using that link in the description of the video. If you found this video helpful, hit the like button, subscribe, and share it with anyone you know who's looking to buy a home. And if you're ready to take the next step, make sure you check out the links below.